Conventional advice tells you that you need bonds to protect your portfolio from downside. There are even rules of thumb that involve subtracting your age from either 100 or 120, and that number tells you what percentage of your portfolio should be in stocks with the remainder in bonds. So, is this sage wisdom, dated advice, or just bad advice to begin with? If you're new here, don't forget to subscribe to the channel and join me today as we explore the place for bonds in our portfolios right here in the red zone. There's a growing body of voices who all state that you don't really need bonds because, first, they've lost their diversification effect, which is why we buy bonds in the first place. Or number two, I don't need bonds for some low interest rate income. I have dividend paying stocks. Or number three, stocks will return more over the long run than bonds, and I need that growth to pay for healthcare, long term care costs, combat inflation, and to support my future adult children living in the basement. Let's take a look at these one at a time. For the first reason that there is no longer diversification, here's a chart dating back to 1997 that shows the price returns of stocks and bonds. This is an aggregate bond index, so it includes both corporates and treasuries of all terms. First, it debunks the myth, at least in recent history, that we should expect stocks and bonds to move in opposite directions, or in other words, be negatively correlated. Over that time period, here are all the times that stocks and bonds have moved in the opposite direction, which is what we think we're getting. And here are the many, many more times that they moved in the same direction. We also see what happened in 2022, where the S&P 500 fell 18.1%, and although the overall bond index was not down quite as much as the 20-year treasury bonds, which fell 26.1% that same year. In 2022, if you were holding a large portion of your portfolio in bonds following, say, a 60/40 makeup, you were probably thinking, really? This finding continues back to 1940 in a JP Morgan piece that showed a negative total stock market correlation with 10-year treasuries only existed 38% of the time. They were expecting that a favorable negative correlation, or stocks and bonds moving in opposite directions, to reemerge soon due to declining inflation. This Franklin Templeton chart is further support that shows negative correlations between stocks and bonds in moderate inflation, but that as inflation rose to higher levels, the correlations turned positive. So we're left with all you need is a crystal ball to tell you exactly when to expect those periods of inflation. So, a strategy of selling bonds for income and retirement when your stocks are down would have only worked 38% of the time since 1940 without selling at a loss. Maybe we're all being advised to own bonds because of beta rather than correlation. Here are two iShares Treasury ETFs, one with T notes with a 7 to 10-year duration, and one with a 20 plus year Treasury bond duration. You can see that their betas are quite low and generally still low even over a 5 year time horizon, which would obviously include 2022. So, for example, in the event of a stock market decline, your bonds could also still decline. They'll just decline less. And likewise, when the stock market recovers, your bonds would also recover less. So far, I'm in agreement that this is not really the type of diversification that I need in my portfolio. Let's move to our second point, which is we don't need bonds because we have dividend stocks. This chart from Simply Safe Dividends shows all recessions and bear markets in the US since the end of World War II. For the majority of the time, company dividend cuts were hardly noticeable, with the exception of the start of the recession in 1968, the recession in 1973, or most recently the great financial crisis in 2008 where the S&P 500 dividend paying companies cut their dividends by 23.1%. Notice if you remove the post World War II bear market and throw out that 2008 period, the average decline is only a negative 1.9%. Now, Simply Safe attributes the large decline in dividends in 2008 to the massive US government intervention with the Trouble Asset Relief Program, where, in order to participate, some agreement to make dividend cuts was required. In my opinion, though, throwing out this time period from the analysis provides a false sense of security. The stock market itself has become one of those too big to fail and will inevitably invite more rather than less government intervention in the future. In spite of the potential for dividend cuts, holding bonds instead is not a good alternative for me, as your payments from bonds are fixed, hence the name fixed income. There is simply no chance for growth. It doesn't mean that you may not want some stability here, but 60/40 portfolio is way too much for me. So, again, on point two here, I'm in general alignment. No bonds in my portfolio. Which brings us to our last point: stocks will provide more growth than bonds. I was actually surprised to learn that according to a recent study by Edward Macquarie, stocks and bonds actually achieved the same general return from 1793 to 1941. Then from 1941 to 1981, stocks outperformed, but from 1982 to 2019, stocks and bonds achieved the same general return. So it may or may not be true going forward that stocks will outperform bonds. However, unlike your financial advisor, I don't think I can predict the future, but I don't really need to because I would not be buying bonds for price appreciation or so called outperformance. So I'm in general agreement with three out of the three most commonly cited reasons for not wanting to hold bonds, but yet I still have a 10% allocation in my red zone portfolio. As I've hinted at, all of the potential points about bonds rest on the assumption that we're interested in the price the bond is trading at. Personally, I have no interest in that as I plan to hold the maturity. So, although agreeing with the general contrarian view here, I still have a place for 007. To mitigate the risk of sequence of returns risk in the red zone, I'm taking 50% of my planned sale of equities and buying a treasury bond that matures at that point. While I'm waiting for that risk to either materialize or not, I'll collect about 4% interest. This buying of bonds in either multiple durations or same duration but staggering the purchases is known as laddering. My plan is if the market is down, I will take some of that matured amount, up to 50% of my planned withdrawal, and use that as my income source rather than selling the full amount of stocks that I would need to sell for income. If the market is net positive, then I'll reinvest into other short to intermediate duration treasuries. Right now, I don't plan to rebalance the bonds at any point, as this laddering is primarily to prevent a poor initial sequence of returns in retirement. And as a result, the percentage of bonds in my portfolio could decline throughout that period. Now, for some, laddering creates complexity. Why not just invest in an intermediate treasury bond fund? For me, investing in a fund defeats the purpose for why I'm investing in bonds to begin with. I could be forced to sell at a lower price as the price of the fund fluctuates. It also creates volatility in the payout, which is also something that is not interesting to me for this asset. I also see no reason to pay a fund manager even a few basis points to do something I can do for free in any online broker or directly at the US Treasury's website. So, do you need bonds? Well, that depends on your plan, how you assess the risk to your plan, and how much mitigation against those risks you think you need. To deep dive more on those risks, as well as learn more about the individual assets that I'm investing in as I transition my portfolio from accumulation to a red zone portfolio, make sure you subscribe, and I'll see you next time right here in the red zone.